$613 billion. That is the mountain of liabilities that toppled a century-old firm and sent shockwaves through markets worldwide. On Monday in mid-September of 2008, Lehman Brothers filed for bankruptcy and the ground under Wall Street cracked. Imagine this was your money, your pension, your home. Could one failure do that much damage? Or was the system already set to blow? The answer lies in leverage, hidden balances, and a device called Repo 105. Tonight we go inside the final days, what executives reported, and the choices regulators faced. The warnings were there, the pressure was brutal, and the path from glossy earnings to a court filing was faster than anyone admitted. But there is more to uncover. Lehman Brothers began as a small dry goods store in the 19th century and grew into a global investment bank. The firm financed railroads, advised corporations, and traded bonds and mortgages. By the early 2000s, it had become a leader in mortgage securities and complex debt products. Those products were built on home loans packaged into bundles and resold to investors. When house prices rose, the fees were rich and defaults were low. When prices slipped, the risks multiplied and losses spread through every layer of the structure. Lehman pursued growth with high leverage. That means a thin slice of equity supported a very large pile of assets. With each step up, profits looked stronger in good times, yet the cushion against losses grew thinner when markets turned. By 2007, warning lights were visible as a rival needed emergency help and credit markets seized. But fear feeds on opacity. Investors could not see through the numbers with confidence. Rumors grew about unsold real estate, about losses not yet recognized, and about collateral calls that would drain the supposed liquidity pool. Inside the company, the liquidity team watched cash move out each day as nervous counterparties asked for higher margins. To slow outflows, the firm considered asset sales, private investments, and strategic deals. None of those options moved fast enough for the pace of the crisis. Against that background, the second week of September became decisive. With markets on edge, leaders from major banks met at the Federal Reserve Bank of New York to hunt for a buyer with private capital. Without such a buyer, a bankruptcy would test every link in the financial system. That sets the stage for what came next, and for the mechanism that made Lehman look safer than it was. The trail leads to a short-term transaction with a simple name and dangerous incentives. The trail leads to Repo 105. To understand the mechanism, start with a simple idea. A repurchase agreement is a short-term loan. A firm gives securities to a lender and takes cash, then agrees to buy the same securities back soon at a slightly higher price. Under normal rules, that remains a loan, and the assets stay on the balance sheet. Lehman used a variation called Repo 105. In some jurisdictions, legal opinions allowed special treatment when the securities posted were worth 105 for each 100 in cash. With that ratio, the trade could be booked as a sale, not a loan. Here is why it mattered. If you can call a loan a sale, you can show lower assets and lower debt on the reporting date. Leverage falls on paper for days. Then, after the quarter closes, you reverse the trades and the assets come back. Step by step, the process worked like this. First, the firm picked hard to sell securities tied to real estate. Second, it entered a series of short-term repos that met the 105 threshold. Third, it used the cash to pay down other borrowings, making reported debt fall. Fourth, it moved to the balance sheet date. On that day, totals looked smaller and ratios looked safer. Fifth, after the quarter closed and the release went out, the firm unwound the trades and borrowed again. The closet filled back up, out of sight until the next tour. Investors heard about liquidity and risk limits, yet not how much window dressing sat behind those figures. The device sat in small print, while scale and intent stayed unclear to the audience that mattered most. Funding was fragile. The business depended on daily confidence from lenders who could pull back at the first hint of trouble. Any sign that reported leverage was managed rather than earned would destroy that confidence fast. At the same time, assets were hard to value. Markets for some mortgage bonds were thin. Small sales would push prices lower, which forced new write-downs and fresh demands for collateral. The firm tried to avoid that spiral by delaying sales and relying on short-term funding. Add it up, and the picture is stark. Reported leverage looked better near quarter ends, while real leverage stayed high. Reported liquidity looked large, while big pieces were locked or pledged and could not meet a flood of calls. The practice drew in bankers, lawyers, and auditors. Opinions abroad gave cover. Internal teams managed the calendar and the cash. Reviewers outside the building focused on final numbers, not on the path taken to reach them. By late summer, this playbook ran into the limits of the real world. Lenders asked more questions, clients cut balances, ratings agencies warned about losses, and the risk of more write-downs to come. The room for cosmetic fixes began to vanish. All of this set up the dramatic weekend that followed. Private buyers had to believe the books, yet the gap between the story and the substance kept growing. That is the turning point, and it explains how the firm moved from denial to the brink. The clock kept ticking, faster each day. The fuse reached the weekend of mid-September. Leaders from banks gathered at the New York Federal Reserve to weigh options. A private rescue looked possible only if a strong buyer stepped in and if problem assets were ring-fenced away from the acquirer. Talks ran through day and night. A potential buyer across the ocean wanted more time and a government backstop. Another suitor turned to a different target. Without a firm bid and without public guarantees, the clock on daily funding moved towards zero. Meanwhile, the liquidity story cracked. Only days after saying the firm held tens of billions in cash, internal counts showed far less free-to-meet calls. What sounded like a lake of liquidity was in truth a shallow pool with rocks just below the surface. By late Sunday, the market had an answer. One bank announced a deal to buy a rival, while the potential buyer for Lehman walked away. With no backstop and no buyer, the board had one path left under the law of the United States. On early Monday, the holding company filed for protection under Chapter 11. It was the largest bankruptcy filing in American history by liabilities, and it landed while markets were opening around the world. Prime brokerage clients rushed to move assets. Money funds and lenders pulled back. In London, administrators stepped in for entities tied to the broker-dealer. Across desks, positions were frozen or dumped at fire sale prices as counterparties tried to protect themselves. The shock jumped across borders in minutes as confidence evaporated. Inside the court record, an examiner would later detail how repo 105 had masked leverage and window-dressed the balance sheet. The report described management decisions, pressure from funding markets, and gaps in oversight by those meant to ask hard questions. Those events reset the crisis. The next days saw an emergency rescue for a giant insurer and a push to shore up other banks. Authorities switched from case-by-case talks to systemic tools, and the hunt for blame began in hearings and reports. But that is jumping ahead. First, we have to reckon with what the failure did to jobs, to savings, and to the wider economy. The damage was not an abstract line on a chart. It was personal, and it spread quickly. Trust snapped and speed won. The filing unleashed a chain of damage. Markets plunged as funds and banks rushed to gauge exposure. Credit froze in places that had looked safe, and companies struggled to roll routine financing. Your savings could have vanished if your fund had to sell into the fall. Pieces of the failed firm were sold off. One buyer took the United States broker-dealer, another took parts in Europe and Asia. Thousands lost jobs in days. Many waited months to recover withheld pay or to unlock trapped retirement balances. Beyond the trading floors, lawsuits and investigations began. An examiner mapped out how window dressing hid leverage. Auditors faced civil claims and later settled with a state attorney general. Directors and former leaders battled creditors for years over what they knew and when. Regulators and standard setters responded. Accounting rules on repos were tightened to reduce the chance that a short-term loan could be shown as a sale. Supervisors rethought how to watch liquidity at firms without deposit insurance or central bank access. The idea of living wills gained force. For the public, the costs were real. Jobs vanished far from Wall Street. Home values fell and foreclosures rose. Retirement accounts shrank. People delayed plans and cut spending for years. From that wreckage, new rules and habits took hold. Yet the memory fades with time, and clever people find new ways to make old risks look safe. That is why looking closely at this failure still matters today. The most important lessons are coming next. First, watch leverage in plain words, not in polished ratios at quarter ends. If numbers shrink on report day and swell between, that is a warning. Real strength does not rely on calendar tricks. Second, follow the funding. If a firm leans on overnight money and fragile confidence, trouble can outrun any plan to raise equity. Short-term funding multiplies every error. Third, read the notes. A small note on unusual accounting can hide a large effect. If answers stay vague, walk before the crowd runs. Fourth, demand oversight that bites. Stop window dressing and stress test liquidity, not just capital. If you want to see more financial scandals exposed, subscribe to Money Mystery. Share this video to warn more people. Which scandal should I investigate next?